Hello, in this lecture we're going to look at a common managerial accounting problem and scenario, that problem and scenario being when a special offer happens. So we're going to talk about where we produce items and we have our normal sales price and our normal level of business, and then if a special offer comes in and the special offer has an added number of units to produce at a special price, a lower price, then the question is, should we accept that special offer? Should we accept that one-time offer? So when thinking about this, we're going to think about when we're not at capacity. So it's going to be a different type of situation if we were producing at capacity. If we're not at capacity and we have room to produce more, then the question usually is, well, is it going to clear our variable costs in order to accept the special offer? Also want to keep in mind that if the special offer is going to affect our current relations with our current clients, that's another consideration to keep in mind that will be outside of the calculation that we will take a look at here. So here's going to be our data on the left-hand side. We got the estimated normal units. We normally have the 200,000 units. Sales price, normal sales price at $387 per unit. The estimated costs, so these are the total costs, and we're going to have to break out the variable and the fixed portion based on this data. Direct materials, labor, overhead, selling expenses, administrative expenses. So these are both variable and fixed totals here. And then the special offer says that we're going to have 33,000 units at $349, which is the special price, lower than the normal price. And we're going to say that the direct labor per unit will increase 50%. And the reason for that is we're going to assume that we're going to have to use some overtime. So we're not at capacity. We could produce more, but we're going to need some overtime hours, time and a half. It's going to increase that rate by, we're going to say, 50%. And then we're going to have the variable portion of the overhead. So when we look at this overhead, remember, many times it's mixed in nature. It has both a fixed portion and a variable portion. We're going to say that 75% is variable. And then we're going to have an increase in admin. So the admin's another one that's usually fixed. And we're going to say it's pretty much fixed, but we're just going to have a set total. We're going to say it's going to tack on 4,000 more to accept this special offer in that case as well. So we're going to work through this out. We're going to try to break out our variable portion and our fixed portion in order to analyze this numerically. So we're going to say the sales. We'll start off with the sales, and we're going to have the per units over here. So normal is 3.87 per unit. The special sales price is going to be 3.49. So without the project, we would then have the 387 times the 200,000 units that we expect to produce, tab. And in the special project, we're going to have the 33,000, that's our special project down here, times the special price, 3.49. So if we combine those two out, then we're going to have the 774 plus the 115, 170, giving us the 889, 170. All right, so then we're going to have the variable costs. So we're going to break out variable, or we're going to do our best to do so. Break out variable costs from fixed costs. We're going to break it out by behavior. So we got the direct materials, and that's going to be equal to, if we're look at the per unit price, we're going to take the total, which is the 256,000, divided by the number of units. The number of units being the 200,000, we get 128. And notice we did add the decimal there so that we have those no decimals over here because we don't want it. We can round it there and be okay with that. Then we're going to have the direct labor. Same idea here, being the direct labor is generally going to be all variable, so we can just take that total of 64,000 here and divide that by the number of units there, the 200,000, and we get the 32 cents there. Then we got the variable portion of the overhead. So overhead, we're going to say that was that mixed one. That's the weird one. So we're going to say that's 192,000. And we said that down here, we said that 75% of it is variable. So I'm going to multiply that times what happened? Times 0.75. Let's go back in there. Let's put an equal sign, possibly could help, times 0.75. Now I'm going to hit enter. I'm not quite done yet, but I'm going to say enter. That would be the 144,000. I'm going to double click on that. And then I'm going to divide that by the 200,000. And there we have the 0.72. Now, you may want, order of operations doesn't require the brackets here, but obviously, I mean, if we were thinking about this, how we would normally do it, we would do this first. So if you want to put brackets to be safe here, we're going to do that. And then we're going to divide by that. And of course, this is one of those items where working it out first in the calculator might be easier to do. 0.75, that's that. And then do the second step divided by the 200,000. And there we got the 72 cents there and there. All right, so I'm going to make this a little bit smaller again, like so. Bring it back down. Okay, so that's going to give us our total variable costs. We have total variable costs. All right, and then I'm going to clean this up a bit. I'm going to indent this. I'm going to highlight this, go to the Home tab, and alignment, indent one time. I'm going to indent this one, Home tab, alignment, indent again. I'm going to underline this one, Home tab, font, underline, and then we'll sum up these variable costs. Equals the sum of the 128, the 32, the 72, giving us the 232. Then we're going to calculate the contribution margin. The contribution margin being the sales minus the variable costs. Now this, of course, is the contribution margin per unit. The sales per unit minus the variable cost per unit gives us the contribution margin per unit 155. If we wanted to put an underline here, which I do, I'm going to go to the Home tab, font, underline, and then we could put a double underline possibly here. Font, double underline, like so. Then we're going to have the fixed costs. Fixed costs here. I'm going to break these out separately. Now these are going to go in the total items because we're not going to break it out per unit because they don't change per unit in the same way. So if we take out the fixed costs, if we had fixed overhead, for example, we don't need to break that out down here. We're just going to pull that directly over to the outer column. And the fixed overhead, we said that it's going to be, this was 75, so it's got to be the 25%. So it's going to be the 192,000 times 0.25 will be the 48,000. That's the fixed portion of the overhead. Then we got the selling and admin, selling expenses. Let's put selling expenses. And that's going to be over here. That's the 80,000. And then we've got the admin expenses. And that's going to be the 53,000. So those will just pull out to the outer side. I'm going to go through the special projects now and do the same type of analysis for the special project. Actually, let's sum this up. I'm going to highlight this. I'm going to go to the Home tab. We're going to go to the alignment, indent that one time. Then we're going to have the total fixed costs. And we'll sum these up. Equals the sum of the 48, the 80, the 53. We can go here. We can go to the Home tab, font, and underline, like so. And there we have that. And then I'm going to indent this 2 times. I'm going to indent this 2 times. And of course alright, so I'm going to go back up here and I'm going to now pull these over to the totals here, and then we'll go back to the special project and complete the same type of thing for the special project. So if we go back over here, I'm going to say now we have the per unit. We know we're going to make 200,000 units on the variable side. So I'm going to say this equals the 200,000 times the 1.28 per unit, giving us the 256,000. Next one, same calculation. We have the 200,000 times the 0.32, meaning we have the 64,000 here. Next item, variable overhead. We're going to say this equals the 200,000 times the 0.72, and that gives us the 144,000. I'm going to underline that. Home tab, we're going to go to the font group and underline. We'll then sum this up. So I'm going to say equals SUM. This is the total variable costs. And then we can calculate the contribution margin, which would be the sales. This is the total contribution margin rather than contribution margin per unit minus the variable costs. And of course, we could also have taken the 200,000 times the contribution margin per unit would get to that same number there. I'm going to go ahead and underline this. Home tab, underline, underline here. I'll double underline here. And then we can get to finally the bottom line, the operating income. So operating income would then be the contribution margin minus the total fixed cost. So notice what we're doing when we calculate this is we're putting the basically kind of the income and expenses in terms of the variable versus the fixed rather than a cost of goods sold types calculation. Going to go to the Home tab, font, we are going to underline here. Then I'm going to double underline here in the Home tab, font, and double underline. Alright, so now we're going to do the same type of thing with the special project. Alright, when we talk about the special project, the direct materials per unit will be the same. That will not change. It changes, it goes up in the same way. The direct labor, remember, we did have something that's usually variable completely, but we said that we're going to have that overtime component. So instead of 0.32, we said it's going to increase by 50% per hour per unit. So we're going to say the 0.32 times, I'm going to say 1.5, 150%. And if we were to put that in a calculator, you could think about it this way. It's 3.32 times 0.5 equals plus 0.32. And or we could think of it as, well, 0.32 times 1 plus another 0.5, 150%, 1.5, and that's going to give us the same number in a, the one calculation. All right, so then the overhead is also going to be the same. So our variable costs have changed slightly due to the direct labor. Then we're going to sum these up, equals the sum of the 125, the 48, the 72, gives us the 248. Contribution margin per unit then would be the 349 minus the 248, giving the 101. And if we then underline that, I'm going to go Home tab, I'm going to underline this, I'm going to go here, we're going to go to the Home tab, we're going to go double underline that. Okay, so now we can get the special project variable cost totals then. We're going to say the special project was another 33,000 units, 33,000 units at, in terms of direct materials, 1.28. And then the direct labor equals the 33,000 times the 0.48. And for the overhead, we have the 33,000, in this case, times the 0.73. Going to go ahead and underline that. Home tab, font group, underline. We could sum these up, equals the sum of the variable cost, 42, 240, 15, 840, 23,760, giving us the 81,840. And then we're going to calculate the contribution margin total, the 115,170 minus the 81,840, gives us the 33,330. And then we're going to put an underline here. We're going to go to the Home tab. We're going to go to the font group and underline. Then we're going to go to the double underline here, Home tab, font group, double underline. And there we have those items. Now on the fixed costs, these fixed costs are not going to, we're going to sum these up in the total. So there's not going to be any added fixed costs for the special project. So it's still good. That's the point, and that's really what the difference is going to be. That's why we really need this analysis here. And we're going to say the 40, that's the same, and then we're going to add another 4,000 for the admin. We said admin's going to cost us another 4,000 on the fixed cost side. So I'm going to go ahead and sum these up. So we're going to say equals the sum of course, just that 4,000, but I'll sum up the whole column anyways. And then the operating income that for the added cost would be the 33,330 minus the added 4,000 of fixed costs, means that we'll have operating income of the 29,330 added to that. And note that when we look at that, we have to break it out to see that these fixed costs will not be included in there, and to really analyze how much of a benefit it would be. It's probably more than a benefit than we would have originally thought, because of the behavior of the fixed costs and because of the way we have to set these sales price. When we set the sales price, we have to include fixed and variable portions, and therefore they change differently when we have different levels of production. So I'm going to underline this. I'm going to go to the Home tab. I'm going to underline. I'm going to go down over here. We're going to go to the Home tab. We're going to go to double underline that, and then we can add these up. So if we added all these up, I'm going to say this equals the normal project plus the special project, or the normal operation, I should say, plus the special project. So we got the 64,000 without plus the special. Then we've got the 144 without plus the special project. Now I'm going to say this equals the sum of the variable portion totals here. And we can go to the Home tab. We're going to underline that. Underline. We're going to go to the Home tab. We're going to underline that. Then we're going to subtract out the contribution margin total. This equals this. sales minus the total variable costs when we combine them out. We also could have added them across this way, getting the same number as we can see there on the taskbar. We're going to go to the Home tab, we're going to go to the font, we're going to double underline, summing these up equals the sum of this plus this, or we could do it this way, equals the 80 plus the 0, equals the 53 plus the 4, and then we could sum up the total fixed cost between the combined and normal operations, bringing us to the 185. I'm going to underline here, Home tab, font, underline. We're going to underline here, Home tab, font, underline, and then we will subtract out here the contribution margin minus the fixed portion totals. It gives us the 158,330. Home tab, font, and double underline. So it does look like the special project is benefiting us. We got the 129 normal operations. It would add to us the 29,330, giving us the 158,330 here. Again, we need to consider the fact that we're assuming we're not at capacity. We can make this adjustments, and it will not affect our normal operations, our normal relations with our existing clients.